Everyone, my name is Dilochna Sri Rajendram. My metric number is 0638323F1147. Now, I'm going to present about case 4. Do you know what happened in case 4? Okay, let me explain. In this case 4, an audit partner and audit team were auditing a subsidiary company that had recently won two big overseas contracts. During the audit, they found something unusual. There was no clear record or timeline showing how those contracts were offered and awarded. While checking further, the auditors discovered large unidentified payments. Later, they found out that those payments were made to people linked with overseas government departments, which looked suspicious and might involve bribery. When the teams tested the company's payables, they found that the finance director had instructed staff to raise purchase orders that were not connected to any approval supplier. Even though are not verified, they are still recorded in payables ledger. The company had also paid high penalty for breaking environmental laws, such as releasing too much carbon and not managing industrial waste properly. Yes. The directors did not take any steps to stop the problem from happening again. To cover up those penalties, the financial director told the staff to record team under cost of sales in terms of showing them as the penalties in the accounting. Okay, let's see the ethical problems. There are four. First, ethical issues in this case related to the integrity and transparency. The finance director instructed payment to be made individuals linked with government department and raised purchase order that cannot be verified with approved suppliers. Such actions raise strong succession of liability and contribution which directly related the ethical principle of integrity under the MIA bylaws, section 110. According to the section, accountants must be straightforward, honest, and fair in all professional and business relationships. By engaging in dishonesty transaction and lagging transparency in financial dealings, the finance direct has compromised the integrity of companies' financial reporting and the public trust in the profession. Okay. Second, the second ethical issue is the threat of objectivity. The financial director instructed the staff to record environmental penalty charges under the cost of sales account in order to conceal breach of environmental laws. This deliberated miscalification of financial information represents a serious misstatement and lack of objectivity. Objectivity requires professionals to remain free from bias, conflict from interest, and undue influence by manipulating the financial statements. The financial director has attempted to mislead stakeholders and auditors, which can affect the auditor's professional judgment is not probably detected. This act undermines the reliability and trustworthiness of the financial information presented. Another ethical issue is evident in this case is non-competence with laws and regulation. The payments of reverse of violation of environmental laws and consignment of penalty shows that the company has failed to comply with legal and regulation requirements under MIA by law section 360 and ISA 250. Auditors have a duty to identify and respond to the instance of non-compliance. Such misconduct not only exposes to the company to legal consequences but also damage its reputation and public confidence. The auditor must assess the impact of those actions on the financial statement and take appropriate steps, including reporting to those charged the governments or related authority if necessary. The final ethical issues concerns professional behavior and due care. The director actions in misclarifying expenses and consolidation variation demonstrate a clear disregard of professional ethics and standard. This behavior constitutes the principle of professional behavior outlined in the MIA bylaw section 150, which require accountant to comply with the laws and regulation and avoid any conduct that discredit the professional. Furthermore, the auditor is obligated to exercise professional competence and due care as stated under MIA bylaw section 113. This means the auditor must perform the audit diligent investigate and succession activities and ensure the financial statement reflect the true and fair view of company's financial position. Failure to do so would compromise the credibility of both the audit and accounting professional as a whole. Let's identify the affected partners. First, audit firm and audit partners. The audit firm and its audit partners are directly affected by the ethical issues identified in this case. If the misconduct by the financial director and management is ignored or not properly reported, the audit firm risks breaching professional ethics and independence requirements under the MIA bylaw, could result in disciplinary action, legal consultation, and several damage to the firm's professional reputation. Additionally, failure to uphold integrity and objectivity could lead to lost client trust, regulation, sanction, and protection removal from professional registrations. Second, subsidiary company. The subsidiary company involved unethical activities faces significant legal, financial, and reputation conservation. The company may be penalty for breaching environmental regulation and engaging in corporate practices such as making payment to individuals linked with government department. Financially, the company may incur fines or loss due to the regulation inventors. Reputationally, its creditable and stakeholders' trust will be severely affected, which could also harm its business relationship and market position. Third, parent company. The parent company is also advisory affected as it may unknowingly issue misleading consolidated financial statement that include inaccurate or manipulated data from the subsidiary. This misrepresentation could lead non-compliance with accounting standard and legal requirements. Furthermore, if the misconduct is exploited, the parent company's corporate image and investors' confidence will suffer. It may also face regulations application for failing to maintain proper oversight over its subsidiary operation and financial report. Fourth, shareholders and investors. Shareholders and investors are among the most impacted stakeholders such as a rely on the accuracy of financial statement to make informed investment decisions. Mistake or false financial result decided them about the company through performance and profitability. This can lead to poor investment decision, financial losses, and erosions of trust in the company's government. Ultimately, unethical financial reporting practicing undermine investors' confidence in the broad capital market. 5. Regulation MACC, DOE, LHDN, and MRA. Regulation bodies such as the Malaysian Anti-Corruption Commission, Department of Environment, Inland Regulation Board, and Malaysian Institute of Accountants are also affected as they rely on truthful and transparent reporting to the enforce laws and professional standard, fulfills informed and non-compliance with regulation hidden their ability to perform effectively oversight. This may investigation, enforcement action, and possible legal proceeding against both companies and responsibility individuals. Public and environment. Lastly, the public and environment indicate but significant affected. The branch of environment laws lead to pollution and harms to natural ecosystem, which negatively impact communicates and public health. Moreover, unethical business practice reduce public trust in corporate responsibility and accountability. When organizations act without regard for integrity and substitution, it damages not only their image but also overall reputation of the business sector in society. Let's see the elevate each solution. First, report those charged with the government reporting unethical or illegal acts. Those charged with the government, such as the audit committee or board of directors, promotes integrity and transparency in the audit procedures. This step ensure that management is lead accountability for those accounts in accordance with MRA bylaw section 110, which is integrity. It also complies with the ISA 260, which require auditors to communicate certificate audit finding to those responsibility for oversight. However, its solution may face challenges such as management pressure or a lack for corrective action from those in government positions. Despite those risks, this approach strengthens ethical responsibility and demonstrates the auditor's commitment to transparency and professional ethics. Second, extend audit procedure. Extending audit procedures demonstrate professional competence and due care as required under MIA bylaw section 113. It ensures that the auditors maintains objectivity and professional scheme when verifying suspicion of irregular transaction. According to ISA 500, auditors are required to obtain certification and operated audit evidence to support their conclusion. This approach helps detect potential misstatement or fraud, thereby improving audit quality. However, the drawback is that it may lead to delay in audit completion, increased audit costs or potential risks by management and access to certain documents. Despite those limitations, it remains a critical steps to uphold audit reliability and credibility. Report under non-compliance with laws and regulation. Reporting under that protect the public interest and fulfills the auditor ethics and professional duty under MIA bylaw section 360. It also upholds the principle of professional behavior by ensuring that illegal activities such as bribery, conservation, or environmental pollutions are properly addressed. Supported by ISA 250, this action allows the auditor to report non-compliance to relevant authorities such as the Malaysian Anti-Corruption Commission MACC or the Department of Environment DOE. Nevertheless, this step may raise confidentiality concern and legal risk if the reporting is not adequate, document, or justified. Therefore, auditors must ensure thorough documents and consulting before proceeding with external report. Fourth, modify or uphold auditor opinion. Modifying or withholding the audit opinion ensure integrity by providing an users by financial statement from being misled by materially misstated information. This approach protects the auditor's independence and professional reputation, demonstrating etiquette to ethical and auditing standard under ISA 705 and ISA 706. Auditors are required to modify their opinion when material misstatements or limitation in evidence are identified. Though, however, this may result in client dissatisfaction, strained relationship, or even lost future engagement. Despite those potential drawbacks, this solution is ethical, sound, and necessary to maintain the credibility of the audit report. Lastly, resignation from the engagement. Resigning from the audit engagement is an appropriate course of action when management lack integrity or when the auditor believes continued association with the client may compromise independence and objectivity. This decision helps the auditors avoid being linked to fraudulence or illegal acts in the line with ISA 240, which provide guidance when fraud is suspected, while resignation safeguards the auditor's professional ethics. It may also lead distribution of audit continuity and create the professional of avoidance or lack of commitment among stakeholders. Nonetheless, these several cases of the computation or management dishonesty, resignation is justified to protect the auditor's ethical standing and professional reputation. Okay, let's see the select and justify the best solution. First, communicate finding those charged in government's ISA 260. The first and most important step auditors should take in the communicate all irregularities and subsequent activities to those charged with governance, such as the audit committee or the board of the directors. This ensures that the individual's responsibility of oversight are fully aware of the seriousness of the ethical and legal issues involved. Taking this action promotes transparency, accountability, and professional honesty, aligning with the ethical principle of integrity and objectivity under the MIA bylaw by reporting directly to those charged with the governments. The auditor demonstrates independence and truthfulness free from management's influence or intimidated. Furthermore, this approach complies with ISA 260, which requires auditor to communicate such significant findings and matters of concern to those responsibility of government. This is a vital step in ensuring the corrective action is taken with the organization. Second, extend audit procedure and apply professional scheme. ISA 500 and ISA 240. The second recommended action is for the audit to extend audit procedure and maintain a high level of professional scheme throughout the audit process. This includes verifying the authorization of overseas contract, unidentified payment supplier list, and improve recollection of eventual penalty. Conducting additional procedures reflect professional competence and due care as required under MIA by Law Section 113. Ensuring that the auditor gathering sufficient and appropriate audit evidence before forming an opinion. According to the ISA 500, this step is necessary to confirm the reliability and competence of financial information, while ISA 240 emphasizes the need for auditors to be alert to possibility of fraud by applying scheme and delegated the auditor, minimizing the risk of overlooking intention misstatements or manipulated by management. Okay. Third is report non-compliance by MIA bylaw section 360. If management fails to take corrective action or refuse to disclose the misconduct, the auditors as an ethical and professional obligation to report the matters to relevant authorities such as the Malaysian Anti-Corruption Commission (MACC) or Department of Environment. This step aligns with the non-compliance with laws and regulation provision under MIA Bylaw 360 and IASC 250, which require auditors to act in the public interest when they become aware from illegal or unethical behavior. Reporting non-compliance ensure accountability and uphold the principles of professional behavior and integrity, demonstrating that the auditor does not tolerate verbally, compulsion, or environmentally violation. Although this may involve confident concerns, it's a necessary step to provide public trust and uphold the law and preserve the credibility of the accounting profession. Lastly, fourth, modify the audit profession if necessary. ISA 705. Finally, the auditors is unable to obtain sufficient appropriate audit evidence, or if management refuses to cooperate, the auditor should modify or withhold the audit opinion in accordance with ISH 705. Depending on the severity of the issue, the auditor may issue a qualified advice or disclaimer opinion to ensure that financial statement users are not misled. This decision reflects strong objectivity and professional behavior is an appropriately ethical responsibility and truth over client pressure or business relationship. Modifying the opinion communication clearly to the stakeholders that the financial statement contain material misstatements or the certification audit evidence could not be obtained. The reflects the auditor role as the independent guidance of the public interest and uphold the integrity of the audit process. Okay, which fundamental principle features more prominently for safeguards? First, integrity. The principle of integrity features prominently in safeguards the auditor's ethical conduct. An auditor must always be honest and straightforward all the professional dealings. In this case, management actions such as making unidentified payments, creating fake suppliers, and cancelling environmental penalties are clearly dishonest and unethical. Upholding integrity requires the auditors to report the truth even if doing so leads to conflict with the client or potential loss of engagement. By maintaining integrity, the auditor preserves public trust in professional and ensure that audit reflect fairness, transparency, and accountability in accordance with MIA by Law Section 110. Second, objectivity. Objectivity is another key principle that must be safeguarded. The auditor should not allow bias, conflict of interest, or undue influence to affect professional judgment. In this case, the financial director's attempts to pressure or intimidate the audit teams to hiding unethical or illegal information threaten the auditor's objectivity. To safeguard the principle, the auditor must remain independent and base all conclusions solely on evidence and professional stance, free from clients' influence, upholding objectivity, ensure that the audit findings are fair, reliable, and consistent with ethical exploration of auditing profession. Third, professional competence and due care. The principle of professional competence and due care emphasize the need for auditors to perform their duties with diligence, skills, and accuracy under ISA 200 and ISA 500. Auditors are required to apply professional scheme and obtain certification application audit evidence to support their conclusion. In this case, extending audit procedures to verify certification payment, supplier records, and constructed auditors demonstrate due care and committed to audit quality. By safeguarding this principle, the audit ensure that audit work meets professional stance and that financial opinion is based on creditable and variable evidence. Okay, fourth, professional behavior. Professional behavior requires the auditors to act in the manner consistent with the reputation and values of according profession. The auditor must comply with the all laws and regulation and avoid any contact that could discredit the profession. Ignoring illegal payments or breach of environmental laws will severely damage public trust and undermine the credibility of both auditor and the organization. By upholding the principle and the auditor demonstrated ethical responsibility in reinforces confidence in financial reporting and ensures compliance with MIA bylaw section 1150. Okay, lastly, confidentially. While confidentiality is a fundamental ethical principle, it must be balanced with all the auditors' duty to act in the public interest. The auditors is generally required to keep client information privately. However, under non-compliance with law and regulation framework, disclosure is permitted and necessary when there is evidence of cooperated bribery or other illegal activities. Reporting such matters to the appropriate audit authorities provides the integrity of the profession and upholds ethical stands. Thus, while confidently remains important, it should never prevent the auditor from acting lawful and ethically when public interest is at stake. Okay. What would be your key consideration in your approach to resolving the dilemma presented? Okay. First, the nature and seriousness of the non-competence. The first key consideration is to assess the nature and seriousness of the non-competence identified. The case involved potential faultiness of accounting records and branch of environment laws, all of which are serious offences under Malaysian legislation and ISA 250 consideration of laws and regulation is an auditor of financial statement. Those actions not only related ethical standards but also explore the company and the auditor to legal and reputationally risk. Therefore, understanding the extent and potential impact of those legislation correction before determining the appropriate causes of action and reporting obligation. 2. The integrity of the management. The integrity and honesty of the management are extensively factors in resolving this ethical dilemma. In this case, the financial director's involvement in unethical practice indicates a lack of integrity and transparency, which raise serious concerns about level and of management as a sources of audit evidence. When management integrity is in doubt, the auditor must exercise greater professional skill and avoid placing undue relation and on management reputations. Elevating management behavior and attitude towards ethical complaints will guide the auditor in deciding whether to continue the engagement or take further steps such as a reporting or resign. Third, professional and legal responsibility. Another important consideration in the auditor professional and legal responsibility, the auditor must comply with the MIA bylaws and relevant international standard and auditing, which emphasize the need to detect and respond appropriately to fraud, non-competence and governance issue. Additionally, the auditor must consider obligation under Malaysian law, including the Malaysian Anti-Corruption Commission (MACC) Act 2009, which is required reporting of all corporate practice. Fulfilling both professional and legal duties ensure that the auditor act ethically while protecting the public interest and avoiding potential legal reputation. 4. public and stakeholders impact. The auditor must also take into account the public interest and potential impact on stakeholders as a professional accounting in public practice. The auditor duty extends beyond the clients to include shareholders, investors, regulator, and the general public. Any failure to address unethical or illegal conduct could mislead stakeholders and erode public trust and damage the reputation of the accounting profession. Therefore, the auditor's action should prioritize transparency, accountability, and protect for the public interest, even the result conflict with the client. Okay. Fifth is safeguards and documentation. Applying appropriate safeguards and proper documentation is vital in managing an ethical dilemma. The auditor should consult the firm's ethical community, seek independent legal advice, and ensure that all findings, discussion, and decisions are through documentary in accordance with ISA 230 audit document. These audit documents provide audit evidence of the auditor professional judgment and due care, serving as protection in the event of regulation review or legal challenges. Safeguards also help the audit maintain independence and ensure the decisions are made objectively and ethically. Sixth, professional scheme and evidence gathering. Finally, maintaining professional scheme is clearly throughout the audit process. The auditor should perform additionally audit procedures to verify the authority of contracts, the legitimacy of suppliers, and the accuracy of payment records as guided by ISA 500. Exercising scheme prevents the auditor from accepting potentially misleading information at face value and at detect activities. This approach ensures that the auditor's consultations are supported by sufficient and authoritative evidence, reinforcing audit credibility and compliance with professional standards. Okay, what course of action would you take to resolve the dilemma? First, communicate with those charged with government's. First course of action is to immediately communicate the finding to those charged with the government, such as the audit committee or the board of directors, in accordance with ISA 260. The auditor has a duty to report all suspicious irregularities, unethical behavior, and possible illegal acts identified during the audit. This step promotes transparency and accountability, ensure that the individual responsibility or for oversight are informed about the seriousness of the matters. It also allows the board to take corrective action and strengthen the auditor compliance with the ethical principle of integrity. Second, extend audit procedures and investigate further. Next, the auditor should extend audit procedure to gather additional evidence and further investigate to suspicious transaction. This involves verification the authorities of payments, confirming the existence of supplier, and reviewing contract process to detect any irregularity. In line with ISA 500 and ISA 240, auditor responsibility relating to fraud in an audit of financial statement. The auditor should also examine supporting documentation such as a correspondence, bank records, and approval form. This step demonstrate professional competence and due care, ensuring that the auditor obtains sufficient and appropriate evidence to support their finding before drawing conclusions. Third, assess the impact of the financial statement. The auditor must Then assess the effect of the irregularities on the financial statement. This includes evaluating whether the unidentified payments and misclassified inventory penalties result in material misstatement under ISA 320. Understanding the magnitude and provisions of those issues helps the auditor determine the authoritative audit response and whatever an adjustment or disclosure is required. This step ensures that the financial statement prevent a true and fair view in compliance with the accounting and auditor standard. Fourth, consider reporting under non-compliance with laws and regulation. If evidence confirms that management is involved in bribery, falsification, or environmental violation, the auditor must report the matters under the non-compliance with laws and regulation framework and outlined in the MIA bylaws section 360. This may involve notifying the relevant authorities such as the Malaysian Anti-Corruption Commission MACC, the Department of Environment DOE, and or the Inland Revenue Board LHDN, while maintaining confidentiality in its important disclosure is ethical and legal certification when it protects the public interest and uphold professional integrity. This action reflects compliance with ISA 250 and demonstrate the auditor's commitment to ethical and legal responsibility. Okay, fifth is the modifying the audit opinion. If management refuses to correct the identified misstatement or false to provide sufficient authoritative evidence, the auditor should modify the audit opinion accordingly under ISA 705. The auditor may issue a qualified advice or disclaimer opinion depending on the severity of the issue and the responsibility of the information provided. Modifying the opinion ensures that users of the financial statement are not misled and the auditor's report accurately reflect the situation. This step safeguards objectivity and professional behavior, showing that the auditor prioritizes ethical responsibility over client pressures. Lastly, consider resignation if integrity is compromised. Finally, if the auditor concludes the management lack integrity and continue to the engagement to fraudulence or illegal acts, despite repeated warning, resign from the audit engagement may be necessary. In accordance with ISA 240, resign is justified when the auditor independent and objectively treated. This course of action prevent the auditor must be in association with unethical conduct and protect their professional reputation. Although resignation may cause business disruption, it demonstrates the auditor's firm commitment to upholding ethical standard and maintaining public trust in the accounting profession. Thank you. That's all from me.